How many of you folks have a lot of your money, your savings, your retirement locked up in the stock market right now? How many don't? How many don't? Well, if you don't, that's pretty impressive. Those of you invested in the stock market, how many of you guys are anxious right now about what's going on? A few are. A few are. The reason I gave this talk now is because last week a couple of people in this meeting asked me, well, are you afraid of a stock market crash? I've read about a stock market crash going into October. And I said, well, you know, that's something I should really think about, because some of the people I read in the financial columns are some very notable people I know are talking about a potential for a stock market crash going into October. And I go, wow, can we weigh the odds for this? What should we do? What should the average person do? And a lot of people are coming up to me, Jack, well, what should I do personally with my financial portfolio? So I gave this talk. I'm giving this talk to try to handicap the odds of the stock market crash. Now, there's a lot of reasons for people thinking this, because there's a thing called the Shemittah cycle, from the Jewish calendar. Every 7 years, there's a Shemittah year. Not only that, there's a 4-year cycle law that people like I will follow, and a 50-week cycle law. Well, the thing about this, to be honest with you, Shemittah year cycles can be very, very nasty. In fact, they can be downright crash-like. So that's why we have to pay attention to what's going on here. Now, since 1900, 9 out of 20 Shemittah cycles gave you more than a 20% correction. That's enough to get you to stand up and pay attention this year, right? Now, the dangerous period is from August to October. In any calendar year, that's probably the most vulnerable time for a stock market. Historically, if you get a crash, it comes in the fall. 2008, remember that? How many still feel the pain from 2008? I know a lot of people were going to retire. They lost 50% of their money very quickly. And they're still battling to get it back. I also know a lot of people who sold and never got back into the stock market. And they're still waiting. Are we going to get a crash so I can get back in? I hear a lot of these people too. But the Shemittah cycles I'm very familiar with, going back to 2001. Remember, there's a lot, 911, the market after fact, the market shut down. It was a tough year. 1994 was the Shemittah year cycle. I've been trading and investing for many, many years. But 1994 was mainly the bond market getting hit. And that's something you have to worry about. Because right now, in the markets, people are showing some fear, and they're going into bonds. But in the Shemittah year, the bonds can be a dangerous place too. So that's another risk factor people have to consider. In 1987, wow, what a year that was. I remember that very clearly. Right now, a lot of people are afraid of a crash. Well, I remember the summer of '87, I went to a business meeting at Idaho National Lab, and everybody in this meeting was talking about the stock market, which is up 40%, 40% from January to August. And we were talking about where the stock market might go, and there's like 15 people in this room. And I just asked, I go, how many people think that, the Dow will be over 3,000 by October? 14 out of 15 people raised their hands. This was in early August of 1987. I go, wow, that alarmed me. And after that, I started buying puts on the stock market every month. Because I go, if everybody thinks the same way, a lot of times it pays to go the other way in financial markets. Stock market volatility. Do you know what that is? Well, if it goes down 50%, that's volatility, right? The stock market for the last year has been trading within a very tight range. The volatility is getting compressed. And stock markets, when the volatility gets tightened, it expands. Chances are that volatility is going to expand between now and October. Otherwise, in other terms, the stock market's going to give us a few scares. Maybe one, maybe two. I think it's a good bet. I think it's highly likely there will be a 10% correction in the United States between now and October. There may be 2 episodes like that. So we're overdue for volatility expansion. But will this be just a correction? Or will this be a crash that could change our economy in a very negative way? what we've been through the last 6 years has been a radical monetary experiment from the Federal Reserve Board. They've never done something like this before. They've injected massive amounts of money into financial markets with the idea of propping up our stocks, propping up our bonds, and propping real estate. I'm worried about that experiment. I don't think it's going to end well. At some point in time, there's no free lunch. That's my #1 rule about economics. There is no free lunch in economics. You just can't print money and paper over problems indefinitely. It can buy you time. But over the long term, there's a price to be paid for that. This country hasn't paid that price for all this cheap money we've been throwing at things. It has indeed tried to support the real estate markets. It has juiced the stock markets. But I think there's a day of reckoning coming. But is it coming now? My bias is it's not coming now. But also this monetary quantitative easing was to create jobs. But the effect of this has made a lot of markets very manipulatable. Our markets, our Federal Reserve Board actively tries to manipulate markets to keep them up. The Federal Reserve doesn't want to see a 20% correction because that will impact what they're trying to do with the economy. So we're in an era where all governments try to manipulate their stock markets. And it's preferable than seeing rioting in the streets to a lot of people. The thing you have to look at now is that let's go back to 2008. What happened in 2008? Chinese market came down first, like it is now. Commodities came down and led the way. A year ago, I mentioned the idea of selling in May, going away for 6 months. A lot of my people who read my financial blog do this. And I think they're happy right now because they're fully in cash. I myself like 80% in cash. How many people have a lot of cash in their accounts? There's a few people. Bless you. Bless you. That's opportunity capital. It really is. So the scenario now is commodities are coming down. In fact, I track gold stocks, oil stocks. They've been leading the market down since May. They did the same thing in 2008. Price of oil is coming down again. And a lot of that's because of China. When their stock market started coming down, the government tried to get a lot of people to play the market in China. Even margin accounts, people that weren't even that educated about it. Well, the downside of that is the market started crashing after a really parabolic run up. And now the government is trying to arrest short sellers and try and keep stocks from trading. It's not really a stock market. But will that ripple through the real economy in China, retail economy? Rose is shaking her head. We don't know. Apple's worried about that, right? Because they want people to upgrade to iPhone 6. Apple's being hit right now because people are afraid that Chinese consumerism will be weakened by this. And that's why Apple and a lot of stocks that do business in China are being hit right now. So that's something you have to worry about because the sign is there. The Chinese stock market's coming down, commodities are coming down, and I believe our market will come down too. It's a question of how much? A 10% correction, or will we get something worse than that? Well, I think the focus of my talk is that I think the real risk to our markets is in the bond markets, just like in 2008. In 2008, the subprime debacle rippled through the stock markets worldwide. I believe there's a real problem in our high yield junk bond market right now, and that thing is trying to lead the market down as well. A lot of my friends who have high yield debt in their retirement, wow, they go, I needed a 7% yield, but I couldn't get anything because of the zero interest rate policy from the Fed. And I said, wow, if you've got high yield debt right now, you're very vulnerable, in my opinion, between now and October. And they says, well, I can't sell it because I have a capital gain. I don't want to do that. And I says, well, then hedge it somehow. You have to hedge this risk. And they said, well, okay. And I said, go to a money manager and try to hedge this risk. You have high yield debt right now. My advice right now is if you have high yield debt, for me and to my friends, I say just sell it in cash. Come back in October. It's not worth the risk because that market is illiquid. And when you have markets that are liquid, where it's hard to sell, big positions, which as you've seen, illiquidity leads to volatility, leads to panic selling en masse. And I'm afraid the bond market is really more at risk than our stock market is going into October. And another thing that's a risk for our stock market is that there's a lot of margin going on. And when that happens, just a small little bit of correction can turn into a waterfall decline. Also, the amount of cash that most money managers have is very low. So if somebody wants to sell in a panic, they don't have cash on hand to redeem the request. So that could cause other forced selling of other things. In China right now, gold has been really hammered. And a lot of that's because of what's going on in China. Now, how does that work? The Chinese are encouraged by their government to hold gold. Not US dollars, of course, but gold. And some of the margin calls in China, people have sold their gold to pay their margin calls, just like we did in 2008 that brought gold down. So I see the ripple effects from China already. To me, so the question is, are we just going down for a nice little correction, or are we going into something worse? And I'm going to show you the threshold, statistical threshold of how this could turn into something more than a 10% correction. But listen, how do you position a portfolio? I've already raved about my friends who are in cash right now. I think high cash right now makes a lot of sense. Converting high yield bonds to cash as soon as possible, I would do that to my friends, but that just depends on your own particular financial circumstances. But if you have cash, this could be a great opportunity to buy that stuff, that thing that you want, that stock that you want. For instance, people who like Apple, a stint bid for $80, $90, good to cancel would make sense. And there's some sectors that have been taken out and destroyed right now. Commodity stocks have been destroyed. So if you think it's not the end of the world, there are stocks there that might be worth checking out. Here's the threshold to watch for. In the Shemittah year of 1987, I followed the market very closely. I worked a day job, 60 hours a week. At home, I'd come home and I would do my market analysis. But in September of 1987, the market had a couple times where it came down 10%, bounced up, came down again, bounced up, came down again, and bounced up. This is typical of a lot of the Shemittah years, if you look at the statistics. I'm kind of a geek about that. And I get a lot of this also from Bob Hoy's report. He actually wrote an article on this. But in 1987, when that market started closing below 10% threshold, that's when it went down 20%. And that's when it went to a crash mode, down 44%. So I think one of the signs here are we're going to get more than just a correction in September. Is this, if we can close below a 10% correction, because the Fed will do some things. Here's what they did last year. Last year I talked about the possibility of a crash going into last year, fall. And we got a 10% intraday decline into October. And then a Fed governor got on CNBC and said, well, we'll just do quantitative easing again. And then the market rallied again. Didn't even look back, right? So the Fed has a lot of things in its arsenal. Right now, the markets are afraid the Fed's going to raise interest rates, which has been talking about ad nauseum. Okay, if the market's down 10%, is the Fed really going to raise interest rates in September? I don't think so. They'll say, we'll do it next year, right? And then markets will rally on that, maybe. But if that doesn't work and the market goes down 20%, the Fed will say, well, we can do quantitative easing again. And that could bring the stock market back up. So the Fed will have a lot of things to do. They don't want to see a market go down 20% because they believe in the wealth effect. If the stock market goes down, that could bring the economy down. And they're worried about that. Their whole thing is to keep the economy chugging along, because if the economy rolls over, despite all that the Fed has done the last 6 years, that will cause a loss of confidence in these guys to levitate assets, which I think is a crazy scheme anyway. They'll be writing about this period 30, 40 years from now, how this is going to work out. I myself think it's going to be a rocky road. My bias, though, is that we're going to get scared a lot here between now and October. I think the bond market's more of a risk than the stocks, but it could be scary. But if you have cash, and a lot of my friends, I have a lot of my friends in cash who want to buy a 20% decline. My bias, and this is just my bias, if the stock market will decline 20%, it's going to come roaring back next year and make perhaps a kind of a blow-off top. So it's going to be a scary ride. There could be a crash. I can't say there won't be a crash. And I do know there's going to be some scary fears. But I see a lot of people that want to buy our stock market if it goes down 10 to 20%. There's going to be a lot of buyers there. With that, it should be an enjoyable ride. If you have cash, might be a time to look at things you might want to own. but the market needs a scare. It needs these kind of scares to clear the sentiment tanks and to allow the market to reorganize itself for the next leg up, hopefully. And we'll see how that comes in the next couple months. Mr. Toastmaster.
Thank you, John.